Today, we're pulling back the curtain on the corporate world. We're heading straight into the command center, the boardroom, to figure out who really has the power inside a company. And, just as importantly, who holds them accountable when things go wrong. It's a world of big decisions, complex rules, and very high stakes. So let's dive right in.
So who actually runs a company? I mean, you might think it's the CEO, right? Or maybe the founders who had the big idea. But the real answer? It's a bit more complicated, and it all revolves around one very powerful group of people. And that group is the board of directors. You can think of them as the company's brain trust. They're the ones at the very top, the ultimate decision-making body that sets the entire strategy and, in theory, oversees everything the company does.
Okay, so what exactly is a director? Well, the law, specifically the Companies Act of 2013, defines them as a member of this board. But here's the key thing. They aren't just advisors giving suggestions. They are collectively and legally on the hook for the company's governance and its strategic path. It's a role with some serious weight attached to it.
Now, a boardroom isn't just one type of person. It's a mix of different roles, all designed to create a balance. You've got your insiders, like the managing director and the whole-time director, who are deep in the daily operations. Then you have the outsiders, the independent directors, whose entire job is to bring an unbiased view. You might also have a nominee director sent by a major investor to protect their investment, or even an alternate director who can step in if someone can't make it. The whole setup is designed to bring different perspectives to the table.
All right, so you've assembled this team of directors. What can they actually do? Let's get into the specific powers that the law gives them. This is where you really see their influence. And these powers are huge. We're talking about the big company-altering decisions. Under Section 179 of the Companies Act, the board gets to decide when to borrow money, where to invest the company's funds, and whether to approve the final financial statements. They can even decide to completely change the direction of the business or approve a massive merger or takeover. These aren't just day-to-day choices. These are the decisions that make or break a company's future. So for all this responsibility, how do they get paid? It's important to know the two main ways because they're very different. First, you have managerial remuneration. That's the big salary package for the executive directors, the ones working full-time. It's tied to company profits and, crucially, has to be approved by the shareholders. On the other hand, you have sitting fees. This is simply a fee paid for attending a single meeting. The board actually sets this fee themselves, though the law caps it at 1 lakh rupees per meeting.
With all that power concentrated in the boardroom, it begs the question, who watches the watchers? Well, the system has a few corporate watchdogs built right in to make sure that power doesn't get abused.
The first line of defense is a set of mandatory board committees. The audit committee's job is to make sure the company's financial numbers are legit. The nomination and remuneration committee, that's a mouthful, basically decides who gets a seat on the board and how much they get paid. And the stakeholders relationship committee is there to handle any issues or grievances from investors. Think of them as specialized sub-teams focusing on the most sensitive areas. And this is where the independent director becomes absolutely crucial. Their whole purpose is to be the impartial voice in the room, the one who isn't involved in the daily running of the company. They're there to ask the tough questions, to challenge management, and to act as a guardian for the interests of all stakeholders, especially the small minority shareholders who might not have a big voice otherwise. What if someone on the inside, an employee or even another director, spots something fishy? That's what the vigil mechanism, you probably know it as a whistleblower policy, is for. It's a legally required, protected channel for anyone to report fraud or unethical behavior without fearing for their job. It's basically the company's internal alarm system.
Okay, but what happens when those internal alarms don't work, or when the problem is just too big and the authorities have to get involved? Well, that's when the game completely changes.
So picture this. There's a suspicion of serious, widespread fraud. What happens next? The power dynamic flips on its head. Suddenly, the boardroom is no longer in control. The investigators are.
And the process is formidable. It gets triggered by either an order from the central government or a special vote by the shareholders themselves. Then, inspectors are appointed, often from an incredibly powerful agency like the Serious Fraud Investigation Office, or SFIO. And once they're in, their powers are sweeping. They can search the company's offices, seize documents and records, and force directors and officers to answer questions under oath.
So what are they really looking for? Well, it all boils down to this. They're trying to cut through all the corporate layers to find out who is truly pulling the strings, who really stands to gain if the company succeeds.
Who is actually controlling its policies, regardless of what the official paperwork says? That's the core mission.
If that investigation uncovers serious wrongdoing, the fallout can be catastrophic. We're talking about consequences that hit the company's bank account, the directors' careers, and could even threaten the company's very existence. First up, let's talk money. The financial penalties can be absolutely massive. Just look at the scale here. A relatively minor slip-up, like an officer failing to file a notice, might be a 25,000 rupee fine. But failing to properly handle investor grievances, that can jump to a crore. And if there's proof of actual fraudulent practices, the penalty can soar to a staggering 25 crore rupees. The stakes are incredibly high. It's not just about the money, though. The personal consequences can be devastating for a director. For instance, if you're on the board of a company that defaults on its financial filings, you can be disqualified from being appointed to the board of any company for 5 full years. That's a massive hit to your professional life and reputation.
And for the company itself, well, there's the ultimate consequence, what you might call the corporate death penalty. If an investigation finds the company was formed for fraudulent purposes or is involved in serious misconduct, a tribunal can order it to be wound up. Just gone.
And finally, there's one more tool in the regulator's toolkit, and it's a powerful one: disgorgement. The idea here is simple. Crime shouldn't pay. It's an order that forces you to give back every single rupee of profit you made from an illegal or unethical deal. This isn't on top of the fine. It's a complete clawback of all the ill-gotten gains.
Which brings us to the big final question. We've seen the incredible power vested in a board, and we've seen the incredibly complex and severe system of checks and balances designed to hold them accountable. So you have to wonder, does this whole intricate web of rules actually do its job of protecting investors? Or does it risk becoming so heavy, so burdensome, that it actually paralyzes businesses and stops them from taking the risks they need to innovate and grow? That's the tightrope every company has to walk.